All right. Good morning, everybody. One of the things that are another brick in that wall of worry is that there are some things in the works to change how unemployment will be calculated. And these changes might put us in line with some critical levels. There's kind of this line in the sand of around 260, 270, depends on which analysts you talk to. And as you can see, like today, we've got continued jobless claims, and these are, below the numbers that we're looking for. If these revisions come out, or the revisions to the way it is calculated, we could see way past that 270, 260 zone and start seeing 306,000. That's going to send markets into a tailspin. If that 306 number comes to fruition, which right now it's still just another brick in that wall of worry. So that, for now, it's certainly something that you're going to want to keep an eye on. Anything that talks about this new formula that they're going to use and the projected new numbers. So it's just kind of this thing that right now is only in the background. It hasn't picked up too much yet, but you're going to want to learn more about what's going on, try to hunt that down and get in the know on that. Globally, we're looking pretty good. Not too bad at all. Hong Kong is leading the way. I thought I saw something on some stimulus this morning, but don't hold me to that. I got to do a little more digging first. It does make sense. Their first attempt was kind of weak, just to be nice about it. It was a little, it left us wanting. So if they did come out maybe with a little more conviction behind that, we could continue to see this rise from Hong Kong. Just keep in mind, any articles that talk about devaluations coming out of China is going to be something you really want to pay particular attention to, because if they do that, which right now they're saying, oh no, we're not going to do that. Of course they're not. They're going to say that all the way up until the moment that they actually do it, and then they're just going to do it. If they do that, those China ADRs are going to pop real nice, but the rest of the market is going to nosedive, right? And another brick in that wall of worry. So Hong Kong is up, leading the way. The NASDAQ right behind it, thanks NVIDIA. The S&P behind that. We get through Japan, which, hey, a 0.5% is a good, decent way to end the day. And farther down, we can see we got the Russell in the red, and we have the Dow Jones in the red, just slightly more flat than the negative, but it kind of speaks to that split, right? The dichotomy right now of what is going on between tech and junior tech and basically everything else, right? But that growth to value, the changing of the guard. So it's certainly worth keeping your eye on today. We talk about the 4 horsemen once in a while. It used to be something we focused on a lot more. We just don't as much because they're so far out of whack from each other. When you do have all 4 indexes moving in the same direction at the same time, you get a much more powerful push, much greater flows in your trades. Today is not that bad. We do have the start at Jackson Hole, but it's a big but. Jerome Powell's tomorrow, not today. And last year, he learned something that I don't think he quite grasped until after he did it, that he has the right, I guess. He has the right to shake the world. And I'm kind of curious if he's going to do it again. Last Jackson Hole was a mic drop moment. It is like the very textbook definition of a mic drop moment. If you don't really grasp what happened last year, just go search for it. I'm sure there was more than a couple of YouTubers who went into detail on what Powell did last year and why it was so impactful. Kind of curious if he's going to do it again this year. He had reason, though, to smack the market down last year. We were kind of in that runaway upside train, and we were kind of tangling up into that 200 period of moving average. It looked like the markets wanted to go back to all-time highs, and they really weren't interested in seeing that happen yet. And so he put the market into a downward spiral. And well, we're on deck to see what shenanigans he's going to do this week. That's tomorrow. So while it's lit up as impactful, it doesn't necessarily have to be. And kind of the base case is that we're going to chop through into Powell tomorrow. So we'll kind of see. I'll show you that when we get into the charts. We do have Japan tonight with economic data that needs to be front and center on, you look at your portfolio and kind of the old phrase, know what you own, and really think about how comfortable you are with, say, a 3% move in the S&P in the overnight hours. You go to bed tonight and we're at one spot, you get up tomorrow and we're 3% away from it, up or down. How comfortable would you be with that? And then my favorites, we got some auctions today, including the 30-year TIPS auction. So it's kind of a full house, and there's seriously a lot of bricks in that wall of worry. And we have Fed speakers today, Harker and Collins. And Turkey did a surprise rate hike. Now, I know, it's like, okay, it's Turkey. Yeah, well, this battle with inflation that's going on around the world is a global problem, and how they combat it around the world becomes a global problem. So you want to pay attention when a nation hikes greater than expected. Most nations don't want to shock the market, right? They try to tiptoe as much as possible, warn in advance if they're going to do something that's unusual or outsized, and kind of try to avoid big shocks. So when they shock with a bigger than expected rate hike, you got to kind of look behind the scenes on that and think, why would they do that? Was things getting so badly out of control that it needed that extra impact? 7:30, 8:30, 10:30, 11, 11:30, and then 1 o'clock. Full house today, no doubt. Nearly every hour on the hour, or with the half hour tucked in there in between, we've got something through the entire morning. So want to really approach with caution. One thing I don't use the words too much, and I really need to use it more often, is the price discovery phrase. It's not just a phrase, it means exactly what it sounds like, but I don't remind enough that people need to be aware of that price discovery. Today, for an example, is going to be really important. They have to price in all of this NVIDIA stuff. And if you're looking at the charts from when they reported, and you see the move that has already happened, you might be thinking, dude, it's priced in, it's moved. No, it's not. It's not done. That's not even close. The market will move in the after hours for a lot of reasons. But most of the people who are going to make decisions aren't sitting at the computer by that time. They're, commuting back home away from the computers, and they're not going to be back into the office until office hours. So still need to price in a lot of what's happened in the overnight, including NVIDIA's earnings. And that pop up gave us a gap that we don't get very often midweek. Normally, the gap that we get in the futures is between Friday's close and Sunday's open in Globex, right? That Globex gap, that 1 hour time frame. But every once in a while, we get a gap in the middle of the week between the 4 o'clock close and the 6 o'clock open. And that kind of gap is a completely different gap than the one from 4 o'clock to 9:30. Because of NVIDIA, we do have that 4 to 6 gap to focus on. One of the easiest ways to find that gap is if you go to a daily chart, because every broker kind of records these values differently. And there are different closes. There's a 4 o'clock close, a 4:15 close, a 4:30 close. But if you go out to your daily, that daily candle is the 4 o'clock close, or whatever your broker is going to use, right? Or whatever the broker deemed appropriate. And hey, if it's good enough for the broker, all right. So that's the 4 o'clock close. And there's the 4 o'clock or the 6 o'clock open. And say something got a little off. Where's my line? Either way, you get the idea, right? That there's a gap there. Now, the fact that the gap exists and that we've already crossed through that level a couple times, crossing through the level is a good start. It's not too bad. It's not too big of a deal. It's the idea of what are we going to do with it, right? Or is it going to carry over and be something that I need to worry about? Yeah, we can't see my line because I've got that indicator at the same spot. So we want to watch this gap today. It does carry through sometimes into the regular trading session. So mark it out. Just throw it through like as a light box. Pay attention as price goes through that zone. The initial balance last night was basically just trying to close that gap. Not much of a surprise, and it took a lot longer than that. Volumes are a little heavier than normal, sitting at 120 when we normally come in at around 100, but they're not enough to be extreme, and there's no market maker move up here. The range for today, 44.96 and 45.22 to the upside. That'd be the ADR half and the ADR full. And then to the downside, 44.44 and 44.18. We are really extended past the weekly pivot point, which is around 44.15, and the daily pivot point, which is at a spectacular level, 44.50. Now look, that 44.50 is a really important level. It's a gamma level, it's key optionality level, it's the daily pivot point. There's a voodoo line hidden behind there. There's a lot of things at 44.50. And the 10-day moving average is right underneath that too, right? So 44.50, 44.48, nearly 44.49, really. I mean, it's that close. There's just so much stuff right there that if we do fade down today, one, that will become gravity. We will go to it. And then very likely it will become a support level. At the moment, we're in an MDP. It's a missed daily pivot. It is exactly like it sounds. We haven't hit the daily pivot. Markets generally hit that daily pivot with an 80% accuracy, right? Like 80% of the time, a market hits that daily pivot point. So when it doesn't hit that pivot point, it actually stands out and it will mean something tomorrow. It doesn't really mean anything today. If you want to learn more about those missed daily pivots, if you go to Google and type in missed daily pivots, MDP, you'll find some research on it and a trade strategy too. I don't really mess with the trade strategy, but I do love using that for my analysis, like what the impact could be, connotations behind just being able to recognize that we have that MDP. Right now, we're looking at a 10-day, 30-minute volume profile in green and the TPO profile in blue on the right side. TPO, time, price, opportunity. One of these is recording trades by time, and one of these is recording trades by price, right? How many transactions happened at this price? How much time, how many transactions happened with this much time, right? So if we look at where we spent the most time, for an example, with all of these at different levels, we kind of lose our classic shape and we've just got a big old mess, right? And that's the transition. We had a shallow area here and we started kind of filling it up. So now it's starting to become this big classic D shape where we were for a little while building out that B shape. We've still got Thursday and Friday's levels. Unless we get back up into that 45, 50 area, then we're going to lose the top of this profile, and this will become the high as we get into next week, right? The phrase is when we're out here is that when we're at the highs, we expect to go to the lows, and when we're at the lows, we expect to go to the highs. The thing is, this is just a snapshot in time. So, next week, say we just continue to fade off from this high, that we don't go up any higher and we fade back. Just suppose that that's the way the rest of the week works out. Next week, when we come in here, we will have lost all of this higher stuff. And by the end of Monday and into Tuesday, that high that we see here, which is right at the point of control, that'll actually be the high. So it'll look like the high that we have up here, this 45, 44, right? And of course, if we sold off from there, we would be looking at it saying the same thing. When we're at the high, we expect to go to the lows. But that wasn't the high at the time, right? I know it's confusing. We spent the whole week on those, right? You want to kind of go back and get familiar with it, or do what I did to get more familiar with this idea, to cement it in your mind. Take a picture of that thing every day at, like, I don't know, 8 o'clock. Every day, take a picture of it at 8 o'clock. And then a week, go back and look at all of them side by side by side. And you'll understand better. All right, we have a VPOC now that was given to us from yesterday. We've got a lot of those stacked up underneath us now. And we took out this 44, 58, 75. And in fact, we ran right through it. It was after hours or right at the hours when NVIDIA, yeah, that was the NVIDIA stuff after hours. So not much of a surprise that we didn't see a reaction to that VPOC. And I'm actually going to leave it on through the day today. It is done. It's not a VPOC anymore, but I am going to keep that level mainly out of my own curiosity. I honestly don't expect that there's going to be any trade out of it. But I use these VPOC levels anyways as areas of concern and or areas where I anticipate there could be a reaction in price. And I'm really curious to see if we do get back to that level, if there's going to be a reaction in price. That's what happens to nerds, right? So we're not just dealing with the 10-day moving average. We're actually dealing with the 10-day and the 10-week. So let me go back in and reset this chart. It got screwed up yesterday. Oh, I love hunting through these charts. Dun, 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 dun. It's fixed. All right, we're at 0.5% above the 10-day moving average because we got through there yesterday. But we also got through the 10-week, right? And so what you really want to kind of be aware of is we're going to just strip all this stuff off, get the lines out of the way. So we can see the 10-week here. That's the blue line that's over our head. And it depends on whether or not you're using the simple or the exponential. So we're going to turn the exponential on, and you can see it's at 44, 48, 25. Now, look, that's not a bad way to go. You can sit there and draw all of that out. Or you can just use an indicator and ask this thing to show you the 10-day EMA or the 10-week EMA on your intraday chart. So you can see that red line I drew is kind of hiding behind there. And we got that 10-week moving average. All right, so that's the 10-week. You can get the 10-day. And you can see how right now they're basically laying on top of each other. This is going to be an area of concern if we happen to fall back down to it. Could be support, right? Either way, if we come back down to it, we want to see it, want to see how we interact with that level. Now, I use these constantly, the daily, the weekly, the monthly, the hourly. You want to plot those levels out, kind of want to know where they are, right? So that if we do interact with them, that you have an understanding of what we hit and whether or not it's going to stick, and if there's an opportunity to trade there. So this just adds that one more piece, right? We listed them out a few minutes ago at 44.50, how important that level is, and we're now above it. We could give it up and fall back again. That's absolutely possible. I don't want to take it off the table, but I don't think so, right? There's certainly a lot of the wall of worry to worry about. We're gonna add another indicator because we don't have enough. Let's do another one. Daily EMA, but it's going to be the 20 period now, because we can see that green line right there, which is my 20 period moving average. Price is interacting with that right now. So kind of want to know where that is, yeah? And we can see that the 50 is still going to be acting as resistance. So if we continue to run to the upside, I need to quit saying support and resistance. These aren't support and resistance. They just, when we look back later, we can point out that they did act as a resistance or that they did help support the market if we look back and see it. But looking forward, we can't presume that they are going to be support or resistance, right? Until it's actually happened, they're not support or resistance. They're just areas where we anticipate a reaction in price. That's it. And as long as you keep approaching it from that point of view, you'll be fine. You'll be able to manage moving averages very well. Just don't get into the habit of ever believing that they're support or resistance, because those are past tense phrases. Anyway, the point I was going to get to here with this pop to the upside is that we are on the road back up. Even though we're under that 50, Tom Bowley laid it out really well that we moved 10% in 2 months, which is what we normally move for the entire year. Over the last 70 years, our yearly average move is about 10% in the indexes. So moving a year's worth of price in 2 months turned that 50 up really sharp, and now we broke through it. So normally if you break through the 50, it's like a really, really bearish bias, but that's not the case this time. This time the 50 moved so fast, they got too close to us and we broke through it. Now we're looking to get back through it. We're looking to get back through it. But if we don't, then it's going to show analysts like Bowley, who believes that this is not exactly your typical 50 break. They're going to change their mind and say, you know, okay, well, maybe I was wrong. And then we're going to start to see some changes of behavior. It's not what we have yet, though. So play what we got. 50% of yesterday, 44, 37, 88. Well, we don't have to worry about 88 in the S&P, right? So 44, 37, and 3 ticks. That's all the way down here. So we've got 44, 37 below those 2 moving averages. It also happens to line up with Tuesday's high. Not perfectly, right? But pretty darn well. So, you know, we trade everything in stages from one level to the next level, to the next level, to the next level, on and on and on. Each one a target, a goalpost, and then when we get there, a reanalysis, a new measurement, and a new target, and a continuation. As long as we hold above that 50% mark, we're still bullish 100% in this week. Let's take it back to the weekly. As long as we hold above 50% of last week, then we're still reclaiming this run back up. And when we look at everything from the weekly, that's just a gentle pullback. That's not bearish, right? And remember, there was a post that I put on my Twitter a while back that talked about how August and September are the times of the year when the market is generally weak anyways and pulls back with a, you know, and then we come roaring out of it as we get into the end of the year. So a lot of reasons for this weakness. This is considered a liquidity gap, by the way. So not just the place at 4 where we closed and at 6 when we opened, but actually where we were when NVIDIA announced and then this thing exploded like a rocket ship. The gap, the liquidity gap, is at 44.48 down here with those moving averages and everything else. And you see how everything keeps coming back to that level. I'm going to be very, very shocked if we don't go to that level today. It's absolutely possible that we don't go there, but I would be really shocked. Speaking of NVIDIA, just because I always like being able to do it at least once a week. I told you. Dun, 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 dun. As a company, this thing has been completely revalued. And the value of this thing is still not met yet. Okay, so it reached 520 last night. That ain't nothing. We ain't done yet. Well, Rocky said, I ain't hear no bell. So who cares? Anyways, what do we got today? One thing you want to be watching for today is the advancing versus the declining issues in the capital. Okay, because we really want to see in all four of the indexes that we really want to pay attention to. Although, you can add 5 to that instead of 4 and start watching the NYSE, the NYSE. So you got the Russell, the Dow, the S&P, the NASDAQ, and the NYSE. Right now, the FANG names are second from the top because the number one thing that's moving today are semiconductors with the SMH. Now, SMH as an ETF for semiconductors isn't bad. And it does hold, some NVIDIA, but then you got to ask, well, how much NVIDIA does it hold in there? And this is one good way to approach earnings on something that you might want to trade, like NVIDIA, but you don't like how costly the product is at the moment because of earnings. Sometimes Thinkorswim will give you a breakdown of what is in the ETF, but not this time, right? If I was to go to like SPY, you can see the breakdown here. So when you don't get this breakdown on something like SMH and you want to know what's in that thing, you can use the Discord bots. I'm sure most people listening to this are, in a Discord somewhere that has a bot that runs this command. So you can do that. And if you just randomly can't or don't know how to do that, you can go to Google. Right? So if you Google SMH as an ETF, you will be able to find it and look at the holdings in it. We used to use a website called Koifin. It was a fantastic, absolutely amazing website. But they went and put all the good stuff behind a firewall. And so now it's not so great, right? Now it's like kind of sucks, really. The free stuff that they have left available to you just really isn't even worth it. It might be easier just to start with what isn't up this morning. Uranium, nat gas, Bitcoin, silver, bonds. Those are things that are down. IWM is down more now than it was when we started, and XLE, but really those are closer to zero. XLF, XLE, XME, reflation trades, right? If we kind of step back and look at the bigger picture, things that are down today are those reflation trades names. What is up? SMH, so semiconductors are up. KWEB, the China ADRs, just general technology. FXI, which makes sense after the moves that we saw yesterday. Pot stocks are up. Emerging markets, which kind of swings back to China, the ADRs. We talked about China being up first thing in this stream today. And then SPY and the Qs, some cloud services, the dollar. One of the reasons that precious metals and gold are down is because US dollar Japan is up. So that makes perfect sense, right? We get that little inverse out of that. This, by the way, is Koifin. And as I said, this is a fantastic website if you buy it. The free version, it's not so great. It used to be. And you can break down nearly any ETF and get the guts out of it. There's other places. Bar chart is one for an example, a couple others. But this is a really powerful website. It's got a lot of tools, and it's not as complicated as it looks. It has built-in news alerts, all kinds of stuff. It's just really great. Used to be really great. Here goes the dollar again. And there goes US dollar Japan. We got that monthly level, 145.90. That's going to help out a lot. But look, the more that this continues to rip like a mad demon to the upside with the dollar, start watching those 10-year yields. Like we got that monthly level, 4.23. If we get through that, we're going to really start to see an impact. Look, the bonds are already making it. S&P isn't doing it yet, but if we kind of track this right there, that breakdown level, S&P took the resistance off of VWAP, started to get the breakdown. We're breaking out here. Everything is starting to accelerate. We're just waiting on that 10-year. This is going to be the key. Right now with the S&P, we've got this micro double bottom setting up, and it's right above that voodoo level, 45.60-ish, right around in there. That's a key level. If we break that, we're going to hit that 44.50. Remember, I still consider that the magnet of today. And I really feel comfortable saying we're going there today. But right now, there's a lot of focus on these bonds. This needs to slow down and calm down. Stop the fact that it's going down at all. We don't want it going down. We need it to go up. We need it to hold the gains that it's already made, but we definitely don't want it to move fast. Fast is even worse than the fact that it's going down, is that it's going down fast. The dollar needs to slow down, calm down, and the 10-year, at least for the moment, isn't moving fast. And that's going to be the last piece of the puzzle. You see this thing starting to pick up speed, watch out. I would say watch out. Anyways, heads up, guys. Something is kicking off here, and it's very likely that we're going to see it before the open. If we do get to that 44.50 with conviction, get below it, mark that 50% line in the sand, but we got 44.35 as a significant voodoo level. That's why it's in purple or whatever, lavender. Yeah. And then we got the cog line 44.11. Which is also a voodoo line. And the 10-year starting to pick up speed. The rate of change, the ROC, is increasing significantly. So I'm going to leave you guys with that nice casual warning that anything that looked really good for a long today, the fangs, the semiconductors, all of those China ADRs, actually the China ADRs might be the only thing that goes well today. If what we're seeing ties back with China, then those ADRs are going to kick off well, but everything else won't. So that's going to be the rug pull. Watch the clock. We got a lot on the schedule today. And keep your eye most definitely on the bonds and the 10-year. You can kind of get away from the dollar or watching US dollar Japan. If you don't have enough charts, you can kind of just set those aside a little bit. Remember earlier this week when I said that there was a disconnect, the dollar and the 10-year were not working in concert, and that we were looking for them to get back into sync, back into rhythm again. They're getting into rhythm again. They're both moving in the same direction now. Not as their rate of change isn't yet. The dollar is much more aggressively moving higher than the 10-year at the moment, but that can change, right? Everybody, be careful. Have a good day.